Rockets and Knicks were in Game 5 when O.J. started that fateful drive. His four-way hazard lights were blinking, and no one knew what the juice was thinking.
I've been to Reno, Chicago, Fargo, Minnesota, Buffalo, Toronto, Winslow, Sarasota, Wichita, Tulsa, Ottawa, Oklahoma, Tampa, Panama, Mattawa, La Paloma, Bangor, Baltimore, Salvador, Amarillo, Tocopilla, Barranquilla, and Padilla. I'm a killer. I've been everywhere, man. I've been everywhere, man. Crossed the desert bare, man. I breathe the mountain air, man. I've traveled, I've had my share, man. I've been everywhere.
This is Oversight Live, your advocate for good governance. We're putting the site back in. Oversight. Here's the watcher on the wall, your host, Ben Carpenter.
Hey, good evening, everyone. This is Oversight Live. This is Ben Carpenter joining you from Alaska. So we've got an interesting program tonight. We're going to dive into a couple meetings that had happened previous to today's legislative session. And I'm going to go back all the way to last session, last year, because I think it's there's something there that we need to hit that's important for what we're doing, what we're talking about this year. I think the subject matter for tonight is going to be permanent fund itself. I'm not going to focus too much on the permanent fund dividend per se. I mean, maybe we'll talk about it a little bit, but I want to talk about the fund and kind of what's facing the state of Alaska with this major thing in our budget. So first off, what's Oversight Live? If you're new to watching, either if you're catching this live or if you got the recording, Oversight Live is my answer to our state capitol being only accessible by plane and by road. Or I'm sorry, by plane and by ferry. It's not accessible by road. We can't get to our state capitol in Juneau by normal means. You got to fly or you got to take a ferry. And it's cost prohibitive to do it. It's a long distance away from where most people live. So most Alaskans don't get to visit and go see, provide influence to their state government very often. It's a challenge for us. It's more of a challenge than it is for other Alaskans. So what is Oversight Live? We're going to be that road to Juneau for you until one can be built. We want to provide oversight of our elected representatives, and I'm going to do my best to bring you pertinent and relevant information, and it's going to be raw. Like, I'm going to show you the actual press conferences, the actual floor sessions, committee meetings, things like that. That's the actual data, so you can hear it, you can see it. You can even go and see it and watch the whole thing yourself, but I'm going to try to pull out the salient parts, because I think that'll help you understand what's going on. So that's in a nutshell what we're doing. If you have questions during the live broadcast, text them in your social media app. If you're on YouTube, text them, and I'll get them immediately, and I'll try to answer them. If you're listening to this on the recording and you have questions, then email producer@oversightlive.com. That'll come to me, and I'll do my best to answer the questions. Look, if you're asking questions, it's highly likely that other people have the same question. So don't be surprised if I use your question on air here on the recording during the podcast and address it for the edification of all. So I'm going to attempt to have some fun here. I mean, who wants to sit around and talk about politics and government and not have fun? Hard enough getting you to focus, to get anybody to focus on politics, but it's important. It's important. So we're going to try to have fun. So with that, let's get started. So I want to tee up tonight's conversation on the permanent fund by going to a meeting that happened last year. It's a House State Affairs Committee meeting, And the topic of that meeting was the spring forecast in 2025. And before the committee was the legislative finance director, Director Painter, and he was presenting the spring forecast and having a discussion with the committee on what was presented by Department of Revenue on the spring forecast. During that conversation, the concept of the permanent fund came up, and the investment strategy of the permanent fund came up, and it's pertinent to the conversation that we're having today. So I wanted to bring that to your attention because you might not have seen that last year, and I wasn't around last year doing Oversight Live. So we're gonna tee this up here, and I'm gonna make sure that it's working. All right. Okay, here goes. So I'm gonna share my screen, and you're gonna get to see it, and hopefully you can hear it. I figured out how to make it all work. All right, let's see. There we go. All right, let's bump. Here am I? You got to look at my face too. All right, so here is Representative Kevin McCabe asking a question of Director Painter.
I mean, as a analyst and a fiscal analyst, should we be changing the way the permanent fund invests? And I know you're supposed to be neutral and all that. I get that, but it seems to me, I've been watching that fund for a long time, and it has so underperformed even my retirement IRA that are we being too you know, I don't know, are we not being risk aggressive enough? Shouldn't we be in more equities and invest more for risk to make more money, or should we just be this very safe sort of bond fund that's really not doing much?
Through the chair, Representative McCabe, so it's a very complicated question. I can't say that I have done independent analysis comparatively. I've seen other people's analysis. The Legislative Finance Division has not been tasked with comparing investment analysis, so I can't say that I've done my own research on it. And it's ultimately a policy call of the legislature of how you want to direct them. You know, it is important to sort of view the full context that we are drawing 5% a year out of the fund. So it's not, you shouldn't compare it to my retirement fund as a person who's still working and is going to be working for, you know, a decade or more. You should be comparing it to, we're basically a retired person in terms of how we use our fund. We want to draw 5%. And somebody who's retired is going to have a more conservative investment allocation, because when you're drawing out, unless you can not take out money in down years, you can significantly hurt your investment performance by drawing out in down years on a more variable fund. You can significantly hurt your investment performance by drawing out in down years on a more variable fund, versus if significantly hurt your investment performance by drawing out in down years on a more variable fund, versus if you aren't drawing, you're definitely better off just riding those swings.
Okay, so what is Director Painter talking about here? He's talking about the yearly variation in an earnings with your investment. Okay, so one year you've got good investments, you made the right decisions and had good investments, the economy was booming in all the places that you put your money, and you had good in returns on your investments. And then the following year, something happened, your investments didn't perform as well, and you had less return on your investment. That's what he's talking about. Okay, that variation. So what he said is that if you've got a fund where you're wanting a draw, like we do, we want a draw, a percent of market value draw, or a different draw per statute, which is what we used to do through a different formula. Okay, but anyway, so the draw from the permanent fund is what we want to do. That draw can go to anything you want it to do, whether it pays for government or pays for dividend or whatever we want to do. Okay. But the point is, if you're going to draw from the fund, then your investment strategy ought to be different than if you're not going to draw from the fund. He's uses an example later here, and we're not going to have time to get to it, but he used an example of himself. He's going to work for another 10 or more years. And so he's got more time. He can be a little bit more risk averse, and he can he's not going to be drawing from his fund. He's just going to keep putting money in, keep investing, no matter what happens, whether it's an up year or a down year. He's just going to keep going. Okay. But if you are drawing and you do have this variation in your fund, and you draw from your fund when it's in a down year, then your earnings potential for the future is diminished because you have taken out in a down year. Okay. Now we define a down year largely two different ways. Your investment earnings don't meet your expectations or meet what you need, or your inflation, the inflation that's happening that year is higher. It's greater inflation, which means the value of your dollar is reduced. Okay. So in a year where you have high inflation and low returns, if you're not meeting your goal, your investment goal, and for the Permanent Fund Corporation, which we'll hear in a minute, investment goal is CPI or inflation plus 5%. So if inflation is over the long term measured in decades, inflation is 2.5%, and that's just a figure you're going to use. Maybe it's what's happened over the last 20, 30 years. It's averaged out to be 2.5%. Then your investment goal is 5% return on investment plus inflation, 2.5%. So you're looking at 7.5%. Okay. So if you don't make 7.5% in a given year, but you draw out 5%, then if you're what you actually made, let's say you made 6%, but you draw 5%. Well, there's 1% difference there that's left. But what if it's less than 5%? Well, then you're taking from the fund's corpus or the principal of the fund in order to draw that fund out because there weren't earnings to pay for it. You didn't have the investment earnings that year to pay for it. So you take that dollar figure out, and we're going to see a slide here in a minute that we'll be able to talk about this. So what I wanted to point out is that financial analysts who are nonpartisan, this is who Director Painter is. He's nonpartisan. He's staff to the legislature, has given us the real truth. The truth is that if you draw from your fund in a down year, you hurt the earnings potential going into the future. Now, it is accurate to say that future earnings could be greater than they were in the down year, and then you could make your money back. But that's not completely accurate because the money that you drew from that fund and the interest that you could have earned on it is not there because you spent that money. So you are, in effect, drawing down earnings potential into the future if you're drawing from your principal in down years. So the question of whether we draw a 5% of market value every year is a real legitimate question if we want to keep the fund growing into the future. If Alaskans don't want the legislature to be able to spend from the fund, then we shouldn't set up a structure that allows us to spend from the fund, the principal, when you have years of high inflation or low returns. Okay. So anyway, so this clip here was to serve as an example that it's not just my opinion. We have financial advice that says if you draw down your principal in a down year, you are going to hurt your earnings potential of that fund going into the future. Okay, now let's jump to a recent meeting. This is the House Finance Committee, and they have the Permanent Fund Corporation before them. We had an episode here the other night where we had the Permanent Fund Corporation's consultant. They're paid to analyze and provide a message. Here is the CEO of the corporation, Devin Mitchell, and the CFO. And we'll get an introduction here and get it going here. All right, there we are. Okay, I'm going to play this, and there's going to be a couple places here where I'm going to stop and have a conversation about some topics here. All right, so let me back this up just a tad. Let's see here. Right about
Frampton, Chief Investment Officer. Gentlemen, if both of you will come forward and put yourselves on the record, you can begin your presentation.
Mr. Chair, for the record, Devin Mitchell. I'm the Executive Director and Chief Executive Officer of the Alaska Permanent Fund Corporation. I have Marcus Frampton with me today, our Chief Investment Officer, and we'll be going through the presentation. I'll start off. Marcus will cover the middle and then jump back to me. We really appreciate the opportunity to talk to the committee in these annual touches. It's Alaska's most important resource from a revenue generation perspective at this point, with 66% was the last number I heard of the state's unrestricted general fund revenue flowing from the permanent fund.
Okay, so somehow that clip was edited or something before I downloaded it, but it jumped right there. Did you understand and hear what he said? 66% of the state's revenue is permanent fund earnings. Okay, that's significant, right? Not a direct connection to oil industry, not a direct connection to our economy. You could do good, you could do bad in the economy. Like our jobs could go up or jobs could go down. We could have a boom or not, and it doesn't matter to that dollar figure, right? That is all has to do with the investment earnings of the permanent fund kicking off money every year that is more than 2/3 of our budget, revenue for our budget, okay? See if I'll back that up a little bit so you can hear it.
From a revenue generation perspective, really appreciate the opportunity to talk to the committee in these annual touches. It's Alaska's most important resource from a revenue generation perspective at this point, with 66% was the last number I heard of the state's unrestricted general fund revenue flowing from the permanent fund. And the fact that we have this resource is because the people that lived in Alaska in 1976 elected to save money for us rather than spending it on themselves. And this is the 50th year anniversary of that event, and is something that's worth celebrating. And we appreciate the opportunity to discuss it every chance we get.
Okay, something worth discussing here. What he's talking to and recognizing, bringing up for discussion here is that Alaskans voted to create the permanent fund, and it was a direct decision by a large majority of the population to say, we don't want the revenue that's coming in from natural resources to just be spent by the legislature in this generation. Okay. Part of the driving factor here is that people thought, well, maybe we won't have the natural resources because, you know, if you pump the oil out of the ground, then the oil dries up and we don't have it anymore. You dig minerals out of the ground, you do whatever with your natural resources, and then it's gone. Okay. So there's this concept of we need to do something for the future. Okay. Another of the concept is just the reality is there were people alive then that probably said, hey, you know, we really do need that money now. Like we really do need it. Like our budgets really need that money. So this is 2/3 of the population saying we don't want the legislature to spend this money in this year. We want it to be saved and be used for future generations. Okay. Juxtapose that with a conversation that's happening right now in the larger fiscal conversation within the state, which is don't tax me, use the permanent fund earnings to grow government, to do whatever you're going to do with government. Don't tax me, just allow the government to spend this resource on itself, even if, and this is where the conversation goes with rolling the ERA into the permanent fund, even if it causes the corpus to be drawn down. As long as you don't tax me, draw your 5% of your market value. I don't care whether it draws the fund down. We'll make it up in the future. Just don't tax me. Grow your government to whatever size you're going to grow. Just don't tax me. Okay? I'm comparing a conversation that Alaskans are having now with what they were having in the past, right? Save some of this money for future generations, because we don't want you to spend it all now. Create this permanent fund and save it permanently, because we recognize that there's going to be a need down in the future. Okay? That's, in my opinion, a little bit more selfless position than where we find ourselves today, which is, hey, we've got to figure out how to pay for our state government without having taxes. And you know what? If it means that we can draw down, if we can get our 5% draw, if we can pay for our government, who cares if we draw down the corpus? We'll bank on the fact that investment earnings will be fine in the future and we'll earn it back. Okay? That's basically what we're saying.
75,588 Alaskans voted for the constitutional amendment to create the permanent fund. That was 67% of the voting population at that time. So a landslide, if you will. And again, we're very appreciative of their vision to transform one-time resource revenue into what we have today, which is a renewable resource generating revenue from the world's economy. The original constitutional amendment did three relatively simple things. First, it said we're going to save money. At least 25% of certain revenue streams are going to be saved. Second, it said that we'll invest the money. And then third, it said that all of the money will be available to the general fund unless otherwise provided by law. And so those.
Okay, one quick thing here. I want to share this with you, because this is key. I have a lot of people, I have talked to a lot of people who think that the dividend is in the Constitution. We are looking at the Constitution online. You can find it yourself. It's in LTGOV for Lieutenant Governor, ltgov.alaska.gov. Okay, so Article 9, Section 15 is the thing that was amended, the people voted on and gave us the permanent fund. So it says here in the Constitution, at least 25% of all mineral lease rentals, royalties, royalty sale proceeds, federal mineral revenue sharing payments, and bonuses received by the state shall be placed in a permanent fund, the principal of which shall be used only for those income-producing investments specifically designated by law as eligible for permanent fund investments. Okay, so as we have as we have a conversation about allocation of investment, an investment strategy and the allocation of our principle for investment, know that the Constitution is telling that the people told the government that the legislature, by designating by law, by creating a law or modifying the law, is able to tell the permanent fund corporation what investments are eligible for the permanent fund. Okay, so while we hire a corporation board of directors to help manage the allocation and make allocation decisions, that is statutory guidance from the legislature to allow that to happen. Constitutionally, the legislature can designate by law, create a law, change a law that says, defines what the permanent fund investment should be. Okay, so just to clear that up as a gee whiz. All income from the permanent fund shall be deposited in the general fund. Okay, so this is the earnings from the investments. All income from the fund shall be deposited in the general fund. 25% of mineral lease royalties, all of your natural resources, right? 25% of that goes into the investment. All of the income gets deposited in the general fund unless otherwise provided by law. So now there were laws put on the books that gave us a reason or a way to do something with it that fits this unless otherwise provided by law. So that creates the dividend fund. It creates a dividend program. It creates a inflation proofing requirement. Those are all in statute, right? Okay, let's go back to our video here. Oop, now it doesn't want to share. Whoops, I gotta stop it. Hold on. All right, entire screen. There you go. Turn the sound on. There you got the sound. Hold on. Oh, I know what I did. There we go. All right, hold on one second. All right, now I figured it out. Okay, I think I that's not what I wanted. All right, guys, bear with me. This should be it. There we go. All right. Whew. Now, I am not where I was when I stopped that video. So let's take a second here and get to where we need to be.
Percent was the last number I heard of the state's unrestricted general fund revenue
We're
flowing
close
from the permanent fund. And the fact that we have this resource is because the people that lived in Alaska in 1976 elected to save money for us rather than spending it on themselves. And this is the 50th year anniversary of that event, and is something that's worth celebrating. And we appreciate the opportunity to discuss it every chance.
Okay, so whatever we're going to do with the permanent fund dividend, and which direction we're headed with the permanent fund here this year or next year, we're at 50 years this thing's been around. I didn't realize that until listening to this video. I mean, if I had done the math and looked at the years, I would have, but I was unaware. So 50 years we've been dealing with and benefiting from this permanent fund.
We get 75,588 Alaskans voted for the constitutional amendment to create the permanent fund. That was 67% of the voting population at that time. So a landslide, if you will. And again, we're very appreciative of their vision to transform one-time resource revenue into what we have today, which is a renewable resource generating revenue from the world's economy. The original constitutional amendment did three relatively simple things. First, it said we're going to save money. At least 25% of certain revenue streams are going to be saved. Second, it said that we'll invest the money. And then third, it said that all of the money will be available to the general fund unless otherwise provided by law. And so those were the components of the constitutional amendment, and subsequently there was a statutory framework wrapped around it that gives us some of the structure that we have today with the corporation and the other sideboards that we operate within. If you think about that concept of if all the money had been spent rather than the statutory framework created, that on the chart on the screen, the kind of brownish total royalty deposits line is how much money would be in the permanent fund right now. So around $20 billion would be in the permanent fund rather than the $86 billion.
Okay, I see the chart. I hear what he's saying, and the two are don't make sense to me. I would have to ask a question of Mr. Mitchell here on what he's trying to get at. Basically, this brown line right here, the chart is telling us that brown line is the total royalty deposit. So that's all of the money that's been put into the fund since inception, and it's roughly $20 billion. Okay, so if we had not have created the fund, since 1976 to now, we would have had $20 billion more to spend. The legislature would have had $20 billion more to spend over the last 50 years. Okay. That's what I take away from this. I don't know what the comment about statutory framework and all that, maybe that's with regard to dividends or I don't know. I don't understand that. It doesn't make any sense, but total royalty deposits does make sense. 25% of all your royalties goes into the permanent fund. That total is about $20 billion that would have otherwise been spent by the legislature, but instead we saved it and invested it.
We had is the time of our last financial statements. You can see the breakdown of principal and the earnings reserve account. There's more complexity to it than's reflected in this particular slide, but this is the general concepts that most people are most aware of. Total return and realized return or statutory net income are the two things that we track. Money becomes available to spend under the realized return, which is statutory net income, but total return is how our funds invested. The lines that go across the chart, the light blue line is the statutory net income or realized return, and the gold is total return. You can see total return is more volatile, but on average it's higher. And so that's why at the current time we have around $17 billion of unrealized gains that have yet to be realized, but are part of the total return that the funds provided historically. So at the corporation, you have a group of around 60 right now, highly dedicated Alaskans and investment professionals that are working to provide the best value for the state of Alaska and the other residents of the state. We are mission driven and have high ideals for our conduct and the work we provide. We have a 6-member board of trustees that's appointed by the governor, 4 of them from the general public, 2 from the cabinet, 1 of which must be the commissioner of the Department of Revenue. And they oversee the asset allocation of the fund and hire and fire the executive.
Okay. I just want to stop and pause for just a second in this slide here and show you something. When it is convenient, we will point to statutory authority and say, hey, this is what we have to do. But when it is not convenient for us and we're allowed to, we will ignore the statute. So the Permanent Fund Corporation is pointing out that their mission is coming from statute here, right? The Board of Trustees, makeup of the Board of Trustees is coming from statute. The principle of the fund is created by the Constitution and by further by statute. The earnings reserve account is created by statute. Remember, we didn't read anything in the Constitution about an earnings reserve account or a PFD. There's nothing in there about that. The earnings reserve account is created in statute. The Emerita Hess settlement is a separate issue. Doesn't affect the permanent fund dividend or how much money we have available for spending for state government, but it's set aside, or the amounts in the investment authority is all, and requirement is all set aside by statute. We can't ignore this. We can't ignore this, in my opinion, any more than we can ignore the statute that says here's the dividend. It's in statute. So we'll follow this one, but we won't follow the other one. Alaska Mental Health Trust Fund, set up in statute, and we follow the statute in regards to that. Power cost equalization, we follow the statute. Okay. One more thing I got to show you. I want you to see this because this goes to previous conversations that I've had. Okay. Why? All right. Constitution, dedication of funds. Whoop. Nope, I was right. Okay. So this is the prohibition against the dedication of funds. It says the proceeds of any state tax or license, that's basically any revenue from the state. It's how the courts have read this, shall not be dedicated to any special purpose except as provided in section 15 of this article, or when required by federal government for state participation in federal programs. The provisions shall not prohibit the continuation of any dedication for special purposes existing upon the ratification of this section by the people. So if it was pre-existing dedication, then it could exist. Okay, so you could only dedicate funds in the state of Alaska if it's required by federal government to get the federal money, or as it's spelled out in section 15 of this article. Okay, so this is Article 9. What's section 15? Bam. Alaska Permanent Fund. So the only exception outside of federal dollars and what was created, what was in effect at the time that the Constitution was ratified at statehood, the only exception to the dedication of funds is what is found in Alaska Permanent Fund, section 15 here. Okay. All income from the permanent fund shall be deposited in the general fund unless otherwise provided by law. So we've got a statute on the books that says this is what you're supposed to do with the income. The Constitution says that this section is an exception to the dedication of funds provision. I don't understand why we have an argument in this state about what to do with the permanent fund earnings in regards to the permanent fund dividend. There's an exception in the dedication of funds clause to allow permanent fund dividend, permanent fund income to be dedicated. Now, if you go up and talk about budget, just so that you can see where an argument's going to come from, every year the governor has to submit to the legislature at a fixed time by law a budget for the next fiscal year, setting forth all proposed expenditures and anticipated income. Okay? At the same time, the governor shall submit a general appropriation bill to authorize the proposed expenditures, meaning the legislature doesn't have to create the bill. The governor's told he has to create the bill. Okay. What this is by law. So when we pass a budget in every year, we are by law authorizing expenditures. So you have a permanent fund provision here that says all income from the permanent fund shall be deposited in the general fund unless otherwise provided by law, but it doesn't specify which law. So you have a law set up that tells you how to pay a dividend, and then you have an annual budget that is a different bill every year because it's a different budget every year, but it is a law. It's a law that gets voted on and authorized, so both of them are laws. So constitutionally speaking, we have the ability to recognize the statute that's telling us how to pay the dividend is a authorized dedication of funds, the way I read the Constitution. And we also have the authority, the legislature has the authority to pass a spending bill that details how to pay the dividend. The two are going to be in conflict if they're not the same number. If the expenditure bill, the appropriations bill, is a different number than the statute that's set up saying that it should be a certain number, well, then there's a conflict between the two laws. But either of those things are legitimate constitutional provisions. So if someone tells you that we can't follow the law, we can't dedicate the funds, I don't think that that's an accurate reading. Like, I'm reading it myself. I'm not an attorney. I'm just reading this plain English. I think that the ability of the legislature to dedicate the spending of the permanent fund dividend is something that's constitutional. Anyway. Okay, there's a couple more things I want to bring up here, and we're going to go back to get back to my studio here. All right.
Director.
Yes, Representative Allard.
Thank you. And I just
And four of which are through the chair, Representative Bannon. Yes, that's normal. I was the acting commissioner at one. I think that having
Okay, I'm just fast forwarding
as
through.
many eyes looking at the corporation and the permanent fund as possible is always going to be for the betterment of our state and the operation of the fund. We obviously, like I said, are operating to a high standard. And if you don't think we are, you should let us know and we'll explain how come we're conducting ourselves like we are. And we can all talk about whether or not there's other ways that that we should accomplish our mission. The other money that we might manage, there's a sub-account of principal within the fund called the Emerald Hes Settlement. We also manage the Mental Health Trust Fund and the Power Cost Equalization Program and monies. And so those two, Mental Health Trust and PCE programs, are around $2 billion that are added to our balance. And so we're around $91 billion that we're running today, which is more than our, if you did the math, more than what we say we have as a fund balance, but it's not, that's just assets without consideration of any liabilities.
Okay. Slide 6.
As far as the fund's investment, when you look back at 1976 in the state of Alaska, and I think it carries forward to today, unfortunately, that the state's economy is viewed as narrow and concentrated in resource development. And that was true in 1976. It's less true today, but it's still how the broader market views our state. And so having the ability to convert our primary revenue stream from our economy to the worldwide economy is one of the amazing successes of the Alaska Permanent Fund. The asset allocation, how the fund is invested, has changed over the years. So initially it was very conservative, all fixed income. That was in part due to just the conservative nature of the day, in combination with the fact that equities had underperformed in the decade of the 1970s. And so you'd come off a time frame where the risk of equities hadn't provided a return relative to fixed income. So it made a lot of sense. As we went through time, there were additional authorizations, flexibility provided by the legislature to allow us to invest in other asset classes, where real estate and public equity was added. And then in 2006, a more broad authorization where we have the Board of Trustees has fairly broad discretion in determining how the fund is invested. We added absolute return and private equity in 2006, and then subsequently have the portfolio composition that's shown in the pie chart with the addition of some other private income, and then just a notion of the cash that's held within the portfolio. And this combination of asset allocation is designed to hit a risk target equivalent to 80% equities, 20% fixed income. And so it's not intended, it's intended to be an at-risk portfolio. If you consider these asset classes and how they compile, which CIO Frampton will describe in a few moments, that equates to similar risk.
Okay, so if we go back to what Director Painter was saying, and again, Director Painter works for the legislature. He doesn't work for the Permanent Fund Corporation. Director Painter does not manage investment income. He assists the legislature in understanding fiscal policy and creating budgets. His comment, though, is germane. If you're going to draw down the principal, if you're going to draw from the principal in order to maintain your fund that is diversified, that is at risk, as what Mr. Mitchell said, then those years where you do not earn enough to cover that draw, you will draw down the corpus or the principal of the fund, and you will hurt your future earnings potential. Okay, that is what we've heard. In 1980, the investment strategy, as he detailed, was just to be in fixed income. And now in 2026, it is broadly invested in things all the way around the world. Okay. This gives us higher risk for loss of principal, but it gives us higher return than just being in fixed income. Okay. All right.
Just in a more diversified fashion where you'll have different cash flows at different periods of time. So on a short-term basis, you might have underperformance or outperformance relative to any one of these particular asset classes, but over the long term, we expect outperformance.
Okay, there's one other thing that I wanted to touch on, and this is going to require me to go back a couple seconds here.
To be an at-risk, and then just a notion of the cash that's held within the composition that's shown in the pie chart, absolute return, or broad authorization where we have the legislature to allow us to invest in other asset class, a lot of sense, 70s. And so you'd come off, was in part due to just the conservatives invested to the worldwide economy as one of having the ability to convert our primary revenue stream from our economy to the worldwide economy is one of the amazing successes of the Alaska Permanent Fund.
Okay, I think this is something that does not get talked about probably at all and is really important. 2/3 of our state budget, and I would just argue that it's 2/3 of the focus of the legislature or more. 2/3 of our state budget is coming from permanent fund earnings, meaning 2/3 of our revenue is coming from investments all around the world, or as Mr. Mitchell puts it, from the worldwide economy, okay? The direction that we're headed is to have 100% or more of our budget paid for by permanent fund earnings. And why can I say that? Well, the goal of the permanent fund corporation is to grow the fund to $100 billion as quickly as possible. You heard him. We're at 86 billion now as of the last financial report. Honestly, where we're at right now is over $90 billion. Next financial report will detail an increase. Okay. The point that I'm getting to is within the next couple of years, we will be at $100 billion. $100 billion with a 5% draw gives you $5 billion coming off of it. Okay. So that's what our draw would be. If we constitutionalize that, roll the earnings reserve account into the principal of the fund and just draw 5%, regardless of how our investments do, then every year we will draw 5% from the permanent fund, regardless of whether we earned 5% or not, or 5% plus inflation. Okay. The legislature will be focused on this map. The legislature will care about where its money's coming from, and it will care about its investments, and it will care about the worldwide economy. Your legislature will not care, it does not need to care about decisions that are being made to the local economy. Let's say that another decade or maybe 2 decades, maybe it's a decade and a half, you double your permanent fund value from 100 billion to 200 billion. I don't know. How long will it take? Compounding interest tells us that it's not going to take as long to get to 200 billion as it took us to get to 100 billion. Okay. So in a decade, in 2 decades, in some period of time, we will have, if we continue the investment the way that we're doing and continue growing, we will end up having a $200 billion fund. Crazy. Like, we can't imagine that, but that's the size of the permanent fund that we're going to hand to our kids. Okay. What do we need with a 5% draw? What do we need $10 billion for to pay for our government? What happens when it's $300 billion? And you've got $15 billion coming off. The point that I'm trying to get to is we are setting up a system here, a structure, whereby our state government is going to have plenty of money coming from an economy outside the state of Alaska, from a worldwide economy. And the decisions that are being made in legislature down in Juneau with regard to spending, taking care of our citizens, have nothing to do with your private economy. They have nothing to do with whether you have more or less jobs in Alaska. Frankly, if you got $10 billion coming off the fund, you don't even need your oil revenue. You do not need an oil industry in the state of Alaska. You've got all of what you need from your permanent fund. Granted, all of your eggs are in one basket, the worldwide economy. So if it takes a dump, then you got a problem, because now the legislature has been focused on how to spend that money and not on how to grow an economy. The connection with the legislature on what is important is where the money's coming from. This is a utopia. I think it's a recipe for disaster for people who like to live in Alaska and who want to see jobs and a growing economy for their family, who want to stay here, I think it's a recipe for disaster. The state government is not going to need anything more than a service industry to service government, because all of your revenue for state government is coming from your investment earnings. It will be unlike any other state in the nation. Every other state, their legislature's got to care about the economy because that's how they pay for things. I think this is a really big risk for us.
The asset allocation, how the fund is invested, has changed over the years. So initially it was very conservative.
Just investing in an index fund. The returns are good there. That I've heard opined on the floor and on the radio is, why aren't you guys just investing in an index fund? The returns are good
Like
there,
the
low
S&P 500.
management cost. It's really easily understood by a lot of the public why the benefits of the index funds, but can you just put in simple terms why you don't take that simple approach and just invest in your classic index fund?
Director.
Mr. Chair, Representative Schrage, I'd actually like to give CIO Frampton the opportunity. I could answer that question, but I think that I would be saying that things that I would have heard from his mouth.
Yeah, through the chair, Representative Schrage, I think it's a really good question because I think index and passive investing is a very sound investment approach. I think the most vocal argument around passive investing has been around the S&P 500, which has been the last 15 years have been like a uniquely strong period for the S&P 500. And if you look at prior decades, there are periods where if you did a back test with a 5% POMV, it would be fairly devastating to be only S&P 500. So I think that argument is pretty easily countered, but you can invest in a diversified fashion with passive and index philosophy, and that is more sound. Among the U.S. state funds, the state of Nevada has embraced index investing more than anyone. They still have, I've heard people mischaracterize what Nevada does. They have a global stock portfolio that's indexed, so not S&P. So their stock portfolio has underperformed the S&P 500 because without the benefit of hindsight, you wouldn't have known 15 years ago. But they have indexed. They have a global stock portfolio and they have a bond portfolio that's indexed. They invest in private equity, but they outsource the implementation, and the same with real estate. So they've got a diversified portfolio just like we do, and they have one employee on the investment staff. And that's a good model, I think. I think that it's worked well for them and is valid. I think, so in the next section, I'm going to go through our investment performance and talk about how I would suggest stakeholders look at how we've done. But I think stakeholders should be aware that there is an index approach that is valid. You're going to see that we've, against the performance benchmark that I suggest we look against, and which has been consistent in the 13 years I've been at the fund, we've beaten it over the 10-year and over the 5-year, and we've had softer performance over the 3-year, the more recent period. And I'll go through why that is, but you asked why not just do that, and I think that institutions, particularly institutions that have limited resources or who don't want to put the cost and effort into one of the most difficult games in the world, beating an index, totally valid approach. I think we've distinguished ourselves with our performance, and I think we've got strong arguments why our active approach makes sense and that we've delivered on it over 5-10 years. But over time, I mean, everyone should be aware that the Nevada model is a valid approach.
Thank you.
Representative Bynum for either Mr. Frampton, who just spoke, or the director.
Thank you, Co-Chair Justice and Mr. Frampton. So when you talk a little bit here in a moment about performance, and we're talking about how well we're doing in the different models that are available to us, one of the things I'd hope that you'd be able to address is the discussion of fees and the cost of actually doing that work. So I hear from the public quite a bit. You guys probably see the chatter out there in the interwebs talking a little bit about the cost of actually trying to get performance. And, why don't we do this or do that? And so I'd really hope that we could kind of cover that because, you could say I'm earning 8% and this managed fund is only earning 7.5% until this is better. But if I'm charging 3 times the cost to get that performance and there's not a net gain, that's the kind of thing that I think that we really need to understand. Thank you.
Yeah, through the chair, Representative Bynum, I'll comment on that now and then I'll cover it as I go through. The first principle is that if you have fees, you should report your returns net of fees, and we do that. I've seen, there's a lot of op-eds talk different. I've seen instances where our fund performances have been discussed and then a deduction is made for a net of fee return, and that's not accurate. Our returns are reported net of fee.
Meaning the fees already taken out.
One of the unfortunate things in the investment industry is that the industry is good at hiding fees and netting them out of the investment and showing them different ways. And when you look at our peers, the vast majority of state funds don't honestly report their fees. And the biggest category is private equity carried interest. And that can be looked at as a profit share. 17% of our portfolio is private equity. When our private equity managers achieve at least an 8% return, after that amount, the incentive kicks in 20% to the firm, 80% to the client. Most state funds do not report that number. In fact, in the United States, there's probably 8 or 9 that disclose a fee report with that. We're in that category. And so when you add up all the fees and show how we report it against how state of Washington reports it, or one of the California plans, their board asks for that number and the staff doesn't even track it. So everyone doesn't even track it because it's like a profit share. And so when you look at funds with our asset allocation and you do fee benchmarking, we're on the extreme efficient side. Like, we're the most efficient, and I can share those numbers. But when you show funds with our asset allocation as reported, we look expensive because we include all the fees, and almost everyone doesn't include all the fees. With that said, our model is more expensive than the Nevada model. But when you look at our model, we operate very efficiently.
Thank you.
Okay. Representative Hannan.
Thank you. And I think my question is actually for the Department of Revenue, although the PERM fund may know, and it's continuing. Thank you, Mr. Chairman. On the same thread, do our other investment fees, investments that the Department of Revenue manages report net of fees also, so that we are looking at apples to apples within our own investment wings?
Through the chair, Representative Hannan, they do report net of fee performance. I'm not certain if they tease out profit share on their private market investments or not. I would defer, but certainly the information that they provide is going to be net of fee because that's the standard.
Okay. All right. We're on slide 6. Is that, you want to move on, or you, okay. Slide 7.
Slide 7 is designed to show the difficulty or the variance in hitting a 5% draw rate expect.
Okay, this is a really important slide, and this ties into the previous conversation that we heard, listened to from Callan in Senate Finance regarding what is the likelihood, what is the risk, or the percentage of that we think that we're going to reach our investment target, which is CPI plus 5%, right? And Callan came in and told us the same thing that you're going to hear here, slightly different, but Callan said, hey, it's less than 50% of the time are we projecting that we're going to reach our target of CPI plus 5%. Okay, so we're going to hear that again. So what does that mean for the decisions that faces the legislature?
So the chart shows a gold dot going across, and that is a target rate of 5% plus inflation. So 5% draw plus you're able to maintain the purchasing power of your fund. And then the bars are 10-year look back, so 10-year averages of return and inflation. So inflation is also return, but it's deducted from return for purposes of calculating real return. So you can see that for around the first 6 of these bars, the performance exceeds the target gold dot. And then for a period of around 10 years, it doesn't hit the target. And then again, it starts hitting the target. And so it's a probabilistic analysis when you start saying what's the likelihood that we're going to be able to provide CPI plus 5 with a portfolio with a risk tolerance of 80% equities, 20% fixed income, and it's about half the time. And so it's just a chart designed to show that 5% is a relatively high target draw rate, but is achievable if you adhere to fiscal discipline over the long term. And market
achievable if you adhere over the long term, assuming that everything continues the way that it needs to continue with regard to the country and investments, and we don't force a national collapse with our debt load, right? I mean, what would happen if we, the fiscal policy at the national level continues to just go into debt instead of balancing the budget, raising taxes, or cutting spending, right? Those are the options they have right now. Raise taxes, cut spending, or continue to go into debt. So if we continue down this path, we keep going into debt, and we're getting to a point where we are at the point where our service on our debt, our interest on our credit card, our minimum payment plus interest is more than we're spending on national defense, right? You're $1 trillion a year in interest. So at some point in time, if we don't solve this problem we have at the federal level of a quarter of our budget being financed by national debt, by national debt, then we're gonna reach a point where the interest payment is too much. It causes a collapse. There'll be some kind of wall hit where we can't afford to pay our bills and the budget that we have. Okay. What happens if the U.S. economy hits that point? We're the largest economy in the world. What happens to all of the other economies in the world if we go through a period of austerity or we're upside down because of the debt that we've allowed to accumulate? What happens to everybody else's economy that's related to the United States? What happens to our permanent fund if it's heavily invested in the world economy and we have some sort of a coming to Jesus moment with our spending and our debt load? I mean, we have to deal with this debt in the future, right? So looking at projections that say, and what's on the chart here is not a projection. This is a look back. But looking into the future that says we're going to have, and this isn't Ben's opinion, this is Callan, subject matter experts, and Permanent Fund Corporation boss and subject matter expert telling you that our strategy, our investment strategy says we're only going to meet our investment strategy less than 50% of the time. And we know that. Okay. That's assuming that things go the way that we're projecting them to go, and we're only going to make it half the time. So what happens if things don't go the way we want to go? What happens if we have some sort of a disaster? Okay. Now the state government, and I'm looking out to what we're handing to our kids, where we are very rapidly going to have a state government completely funded by the permanent fund earnings. Okay. Totally reliant upon a national and international economy. And I'm going to argue that's to the exclusion of your local economy, your state economy. Who cares if that grows? The state budget doesn't care. It's not connected. It doesn't matter. Half the time, you're not going to meet your goals, your investment goals. And with the provision that we have sitting in front of us to roll the earnings reserve account into the corpus, make the 5% market value a constitutional provision, meaning the legislature gets to draw 5% from the fund, regardless of whether this is we made our goals this year 50% half the time, or this is hey, we didn't meet our goals this year 50%. Regardless of whether you had a good year or a bad year, you're going to draw 5% out of the fund. So you're going to draw from the fund. You're going to draw from the fund. So this provision about rolling the earnings reserve account into the fund and the accompanying narrative that says, hey, we've got to protect the fund, that is smoke and mirrors. It is not true. It's not true. It doesn't protect the fund. Right now, the legislature cannot spend from the corpus, period. End of sentence. You cannot appropriate money from the corpus. That's why it's been able to grow. That's why it's never been hurt in a down year, because we've spent from it. Yeah, we didn't realize our earnings, or we had a decline in the total balance, but it wasn't because of us. It wasn't because of our spending from the fund. In a down year, you would see $90 billion, or if you had a recession in the worldwide economy, you would see your value of your fund go from 90 billion to 80 billion or 75 billion. It's going to drop somehow, right? And if that means that your investments didn't keep up, then not only is your value of your fund dropping because of your investments, but now you're going to have a 5% draw come off of it. And you've just constitutionally given yourself the right to draw 5%, regardless of whether the economy is doing good or not. And so you're going to draw down the value of the fund to maintain state spending. You're not looking at a private economy, the economic engine of the state, to pay for your government. You're looking at your national economy, and you're looking at your fund. 100% rolling the ERA into the fund guarantees, regardless of what else is happening in the world, that your state government is going to be paid for. That's what it guarantees. It is protecting the payout. It is protecting the draw, not the fund. Now, if it was going to protect the fund, the provision that goes into the Constitution would say something to the effect that the only amount that you could draw out is if you've taken care of inflation and you've met your investment goals. So after you've met your investment goals and after you've taken care of inflation, then you can draw a certain percentage. But you can't draw a percentage greater than what it takes to cover inflation and what it takes for your investment earnings. So if you were able to put that in the Constitution, then you would protect the corpus of the fund, because then you wouldn't be able to draw more than either inflation, covering inflation, or your whatever you earned on your investments that year. But that would mean that the draw would be less. See, this is what the powers that be want, is to make sure that government has a perpetual source of revenue. The government will be taken care of with permanent fund earnings. And there are many Alaskans that are saying, heck yeah, let's do that. Don't tax me. Don't tax us. We want that as a strategy for paying for state government. Go ahead and draw down the corpus of the fund, draw down the principal of the fund, give ourselves the authority to do that. It doesn't really matter as much what future generations might lose from that, as long as we pay our bills today. This is no different, my friends, than what's being said at the federal level that says, don't tax us for our federal spending, go into debt, and make future generations pay for our spending today. It is the same exact principle. The economic engine of the state of Alaska cannot support the size of our government. So we're going to rely upon the permanent fund to do that. regardless of whether it draws down. That's the plan that people want to put in place. We cannot, our private economy right now, our U.S. economy is not paying for our national budget. A quarter of it's being financed. So we're saying at the federal level, we're saying the exact same thing. Don't tax me for the spending that I'm demanding now. Tax my future generations. Tax my kids and my grandkids. They'll pay back the debt. When did fiscal conservatives, responsible people, become no tax people? When did responsible Americans and responsible Alaskans say, you know what, I would rather not pay taxes, and if you can find some way to make somebody else pay, especially the next generation, then let them pay for it? When did conservatives become that? I mean, I get it. The socialists are that way. Alaska's becoming a socialist utopia. This year's budget, our spring forecast is showing that this year's budget, fiscal year 27 budget, is forecasting $200 million more in permanent fund earnings than we had last year to spend. And this is the point that I'm trying to get at. I want people to see this. If your goal is to grow the fund and it's growing every year, then you've got more money every year to spend on government. $200 million more. You're going to have a $200 million larger budget this year. That's not an exactly accurate statement, because your other source of revenue from oil isn't doing as well. So there's a decline there. So it kind of balances out. But the point that I'm getting at is, in the future, when you have all of your state government spending coming from your permanent fund earnings, and you have a $200 million increase in revenue that's available because your fund grew, then your government has $200 million more to spend. Do you want a $200 million larger government next year than what you have now? At what point have we spent enough on state government? This is the structure that we're setting up. I wonder if Mr. Mitchell has anything more to say on this slide.
Did you have some comments?
Mr. Frampton.
Yeah, thank you through the chair. Well, at this point, the following slides I'm going to cover, starting with how to think about the performance of the fund. But just starting on this slide, like I said, I started around 13 years ago in 2012 at the fund, and we hadn't achieved a CPI plus 5 over a trailing 10-year basis for several years at that point, coming out of the financial crisis. And then by the time we got to 2019, we were back around CPI plus 5 and then higher on a 10-year basis. And it mostly has to do with how the markets are doing. So in the decade of the 2000s, it was a very difficult equity market. We had the dot-com bust and then the global financial crisis. So almost no portfolios hit CPI plus 5 at that point.
So another way to look at this, as he's talking, I'm thinking through this. So what happens when he just recognized there were many years where we did not reach CPI plus 5. Okay, on the previous graph, the big hole in the middle, we didn't reach CPI plus 5. Okay, so if we had the ERA rolled into the corpus, into the principal, and if the constitutional amendment said you can draw 5% out regardless of what your investment earnings are, and regardless of what inflation is, then during those years, we would have drawn down the principal of the fund in order to pay for state government and or pay for dividends, same thing, right? So what that's in essence saying is the following year, when we do pay for, or we do reach 5% plus CPI, whatever money we drew from the principal, think of it as a loan to ourselves in the future, because we had those dollars to invest, but we chose not to invest them. We spent them instead. Okay. So now the next year when our investment earnings improve, we're going to pay those dollars back. Plus we still have to earn enough to draw 5%. So your investment earnings the following year have to be better than CPI plus 5 in order to provide enough to draw for that year, plus pay back the money that you spent from the principal the previous year. Okay. So if somebody says, well, over the long term of the fund, we're going to earn 8%. Okay. Well, then that means that every year that you earn 8%, which is, CPI plus 5% is 7.5%. So you're 0.5% above that target. Then if you're only earning 8%, then how many years is it going to take you to pay back that money that you took out in the previous year where you were below your investment target? You see, you would have to actually, if you want to pay back, if you've got numbers of years, low years of drawing from the fund, then you've got numbers of years and that much better investment earnings in the future to pay that back. Now, here's the thing. That's just if you're just looking at the principal that you pulled out. But that principal represents earning potential. And it represents what can happen with compounding interest. So if you go long enough and you don't pay yourself back you don't have good enough investment earnings where you're going to pay yourself back, then you're missing out on the compounding interest that could have happened with that money that you pulled out of the principal. So it's not just earning enough money in future years to pay back the money that you pulled out. It's earning enough in the future years to cover the earnings that you could have done with that money. And what you need to be able to do that is time. It's the compounding of interest that matters. Allowing ourselves to pull from the fund when we are in down years is the same thing as saying we're going to go into debt and ask our future generation to pay for it. They have to make better investment decisions in the future for us to pay back the money that we came out plus with interest, with earned interest. That's what it's saying. It's the same damn thing that's happening in the federal government. So let's listen to Mr. Frampton tell us how we should be thinking about investing.
And going forward, like Devin said, we think there's about a 50% chance that we'll achieve CPI plus 5, and that's the same as the history here on this page. And there are 3 yardsticks that at a high level we can look at on performance. I'll start at the bottom of this page and go up. And just to note the time periods here, the fund's been around 50 years, but we've worked with Callan Associates as our consultant for 42 years, and we have good performance data for the last 42 years. So that's why that's the longest time period. Later, I'm going to get to how staff and the board works through asset allocation. But suffice it to say, that's the first cut at trying to achieve a portfolio that achieves CPI plus 5. If there was a investment security that yielded CPI plus 5, we would just invest in that security. But inflation protected bonds issued by the US government give you about a 2% real return today. So to get to a portfolio of inflation plus 5, by definition, you have to take investment risk. And we build a diversified portfolio that is targeting with about a 50% probability CPI plus 5, and we mitigate the risk inherent in that through diversification. And you'll see over the 42 years, we've achieved better than CPI plus 5 by close to 1%. The 5-year period is the toughest look on inflation plus 5. And that is because inflation's been so high. Like over the last 5 years, inflation's been almost 5%. So you had to do 9.5% to hit that, and the fund did 7.9%. Over that time period, I think the average risk-free interest rate was probably 2%. So that 7.9 is vastly more than you would have gotten like in a bank account or something like that, but did not achieve the inflation plus 5. And then more recently, as inflation's come under control, the performance of the fund has greatly exceeded the CPI plus 5. I think at the end of the day, that measure, CPI plus 5, mostly should be looked at on a 10-year basis like we did on the previous page. And it's a yardstick of, do we have the right asset allocation to achieve this type of return? It's less to do with, are we picking the right managers, or are we investing in the right real estate, things like that. It's mostly an asset allocation.
Okay, so he's saying that this number right here, return objective CPI plus 5, 10-year average 8.2. Okay, so your target of what you're trying to get is CPI plus 5. So if CPI is 2.5% over the long term, and you're at 5% plus CPI, then you're 7.5%. Okay, so the difference between 7.5% and 8.2% is a half plus 0.2, 0.7%. Okay, so you've got an advantage to yourself in your investment of 0.7%. If during the low years you drew down the principal, then your 0.5%, your 0.7% has got to make up that difference. How many years of 0.7% above CPI plus 5, because that's what you're drawing out every year, or is 5%, and you've got to earn CPI, you got to earn inflation, right? So above that, you're earning 0.7% interest, and the amount that you pulled out of the fund in the down years, you got to pay that back if you're going to hold harmless the future generation. So you're going to do that. He's saying use the 10-year outlook, and really your outlook is going to be, best case, you're going to get 8.2%. Okay, but in reality, that means 0.7% interest of a benefit to you to pay back whatever money you had to take out of the fund in order to make that 5% draw every year. Plus, that money could have earned interest. So your 0.7%, it's a wash. It's a wash at the end of the year if you're actually comparing what the money you remove from your account, from your investment earnings, plus the interest that it would have earned at your target, CPI plus 5, over the next years that you're going to be investing it. It's a wash because you're only getting 0.7%. So you're costing yourself more by drawing down your corpus than you're ever going to hope to earn. And that's why you end up drawing down the fund. The fund looks like it continues to grow. You're not comparing what it would have looked like if you hadn't have drawn down the money and you would have invested it instead of spending it. You're not comparing it to that. And that difference in benefit is what the future generation doesn't get, because they weren't here when you spent the money. They don't get the benefit of the compounding interest and the benefit of the investment in the future because you spent it. You didn't invest it. So yeah, the fund grew, but it didn't grow. It didn't grow with the money that you spent. So you're literally telling the future generation, you're going to have to do with less because we need this money now. That's literally what we're telling the future generation. These people are never going to say that. It's short-sighted.
Assessment. Once we arrive at an asset allocation, I'm going to get to how we do it in a minute. The performance benchmark is created. And on the previous slide with the pie chart on the assets we're in, Devin had a page that shows we're 32% global stocks. So our performance benchmark is 32%. What did global stocks do? We're 20% fixed income. The performance benchmark has 20% institutional fixed income on average, how it's doing it. So every asset class in its proportion, how it did on average versus how we did. And so I think that benchmark is the measure of, is our active management versus like a Nevada model adding value. And so interestingly, like if you look at the 42-year period, we have underperformed on that measure, the far right column. You could debate how good or bad that is. The benchmarks don't deduct fees. Even if you're indexed, you're going to be charged some fees. But over 42 years, the fund has underperformed its performance benchmark by 0.09%. When you get more recent, over the last 10 years, we've beaten by 30 basis points, 0.33%. And since I've been at the fund over that period, an observation I have is that 13 years ago, we had a very conservative orientation. And I think everyone at the fund then and now has always worked very hard to do their best for our stakeholders, but there are investment institutions that take a little bit more risk, and there are ones that want to hold a little extra cash and take a little less risk and be more conservative. And the ethos 13 years ago was definitely conservative. And I think we're balancing in the last decade performance and risk aversion a little bit better, and that's showing up in the 10-year number where it's beating.
Better is not the right word.
And over 5 years, we're also beating by 16 basis.
We're taking more risk. And I don't know, I mean, maybe that's better, but it's the better is in the eye of the beholder here, I think. And let me I'm not sure whether everybody's, if there's any questions on this, right? So I just want to be clear. This 42-year average that he's saying here, return objective 7.8. The reason, or I guess what he's saying is the actual fund return 8% is missing the benchmark, or missing what we wanted, because in the early years, go back to that previous slide that we saw where it was the circles on the slide were showing what you're investing in, the fixed assets or fixed investments, I think is what it said. The early investments were less risk and less return. Okay, so that number for the 40-year average is covering, it's taking into account the early years where you didn't attempt to get a larger return. And so as an average, it draws down the total return over that time period, because you didn't get as much earnings as you have in recent years where you were investing in different things that had higher returns, right? So if you started measuring 10 years ago, again, it says it on the page there, your 10-year average is higher because that's where you started measuring. Now, if you started measuring 5 years ago, then it's not good because we had some down years, right? 1 year ago, if you're only measuring 1 year ago, then we're knocking it out of the park, right? Okay. All right, I think I'm about talked out with permanent fund. The point that I wanted to get to is let's stop sharing that. Point that I wanted to get to is the Permanent Fund Corporation and their paid consultants who are providing advice to themselves and to the legislature are acknowledging the fact that you have less than 50% chance that you're going to beat CPI plus 5 every year. And the goal of the legislature here for some is to roll all of the earnings, protect the earnings from being spent by the legislature, and put it all in the corpus, all in the principal, by rolling the earnings reserve account into the corpus and then constitutionalizing, going to you for a vote, saying, hey, we need to protect the fund, which means protect the earnings reserve account from being spent, but protect the fund. Again, the earnings reserve account is not a constitutional provision. It's a statutory provision. But protect the fund. So roll it into the Constitution and then allow the legislature to spend 5% constitutionally. Call it a spending limit because you can't spend 6. You can only spend 5, regardless of whether you have investment earnings or inflation that makes that a wise spending decision of 5%. That's what they're setting up. That's the conversation that's being set up. And now they'll make an argument that says, well, maybe 5% is not enough. Or I'm sorry, maybe 5% is too much of a draw. Maybe it needs to be 4.5%. That way you don't have to make 5% plus CPI. You only have to make 4.5% plus CPI. So rerun the formula, rerun the equations here. How many years would we have missed the 4.5% plus CPI? The thing is still the same, right? The end result is still the same. If you have years where you don't meet your earnings potential, I remember seeing where we had negative returns one year. Okay, negative returns plus inflation. You're drawing from the corpus. You're drawing from the principal to make your 5% draw that year. Okay, future earnings go out the window because you spent that money. Future generations don't get the benefit of your investment. And now you have to earn that much more in future years to pay back that loan you took out. Okay, that's where I wanted to get. That's what they're not saying. Noticed how he stated that you don't need to change managers of the PFD. Managers of the fund, I think maybe you mean. Yeah, he's making an argument, and the meeting will go on to have a conversation about the investment earnings and how they do their allocations and all that. We're an hour and a half into this. Maybe we'll have to come back and listen to that part of it. But yeah, there's an argument being made that we don't need to change our fund. And what we're going to find out, I think, is there's $900 million that's being spent to get this earnings. Okay. We've grown the fund to above $90 billion now, $90 billion, but it costs us $900 million, almost $1 billion a year to do that. That diversification is providing jobs for quite a few people. Whoever's accepting those fees is making bank off of the Alaska Permanent Fund, off of the Alaskan people in our investment strategy. What Frampton was saying is, yeah, well, there's other funds that don't do that. They don't pay $900 million to invest their money. They invested in a indexed fund like the S&P 500, and that doesn't cost as much. There's consequences, trade-offs with every decision that you're going to make, but at least we need to be talking apples and apples here and understand, if we're giving up $1 billion, or it's costing us $1 billion every year, plus we're dipping into the corpus or the principal to pay our 5% because our investment earnings, that $500 billion didn't get us CPI plus 5. Whew, who's the chump? Like, this is not working out for us this year. You got to do really well the next year or the next decade, right? If you don't, no big deal, right? It's just the future generation that lost the benefit. All right. So again, it's all on the backs of which people? Like the failure to predict the right system and to put the right system in place where we pay the price means the future generation people, the future people it'll be on their backs. It's not on our backs. We're avoiding it. We're avoiding it. This is the whole conversation. The whole point of this conversation. We're avoiding the cost of our government. We don't want this either at the state level or the federal level. We're like, you do whatever you're going to do with government. Don't tax me. Don't force me to pay for it. Even to the extent of forcing the future generation to pay for it. Have to pay back debt at the federal level or less benefit from investment earnings. Like, it's not on our backs. But that's the thing. It's not on Alaskans. I mean, I guess if you're saying it's on your back because you don't get a dividend, then yeah, got it. That's your tax. That's your contribution to this system that we're establishing, is you're just going to give up your dividend. Yeah. I don't think that the government is going to hold itself to only spending investment earnings. I don't think that that's the case. I think that there's going to be people that say, hey, investment earnings is just not enough. All of Alaskans got to pay their fair share, and we're going to end up with a tax. This is what I've been saying. You're going to lose your dividend and have a tax, or you're going to keep your dividend and have a tax. Either way, you're going to have a tax. That's what the legislature is going to do. The question is, what are you doing for the future generation? What are you turning over to them? Yes, you'll be taxed regardless. So the question is, who is going to be taxed? Who is the burden falling on? If all that we're required to do is give up the dividend, then it is the poorest among us that is most impacted by that decision. The wealthy people that don't need a dividend, doesn't matter to them. Yeah, I get it. It's already a tax. We're not calling it a tax, but it is. It's statutory money. Constitution says, hey, by statute, you're supposed to do something with these earnings. Okay, we'll create the statute. And then we won't follow the statute. We won't pay out the statute. We'll take that money instead and spend it on government and not call it a tax. No, that's what it is. It's a tax. The government doesn't get to spend anything without tax. There's no like government's not generating wealth. They're not creating something with this. They have to take it from somewhere. It's spending is taxation. That's the way it is. You want to spend more, you got to take that money from somewhere. And the future, Lisa, you're exactly right. It's the future. We will tax the future. We're already doing that at the federal level, and if we give ourselves that authority to spend out of the principle of the fund, we're going to be taxing the future as well. So again, this is why I said a better plan for the state of Alaska is for the Alaska legislature to care about the private economy by having a tax structure that requires whatever spending people are demanding. It requires you to go to that part of the economy and say, well, do you want to pay for additional government? That's going to put a downwards pressure on growing government because people are like, yeah, heck no, I don't want more taxes. It's just not the same when they take the dividend and you never see it versus they have to take money out of your pocket. It's human nature. You don't approach it the same way. They're like, oh, I could have got $2,000 or $3,000, but instead I only got $1,000. That's a totally different concept than, you know what? I had $1,000 in my pocket and they just took it from me. Completely different human reaction. So this is my thinking. I think it's a better system if we're going to have a permanent fund that some of that money gets earmarked, dedicated, whatever you want to call it. It gets spent to the people so that they can spend it in the private economy. And then the private economy can help sustain the government so that there's a connection between the spending and the private economy. Otherwise, we're setting up a system where the state government does not need the private economy. Doesn't need it. Maybe I need to explore that a little bit. Why would the government, why would it be in our best interest for the state government to need the economy? Well, think about it in terms of this. There are decisions that impact the private economy. Okay. Let me give one real big one. It's people. Okay. So when you have a lot of money flowing into the state government, a lot of free money, a lot of permanent fund earnings, the best jobs in the state are going to be government jobs. Okay. So what does that do to the private employer? If the state continues to pay more for employees, that means you have to, as a private employer, you have to compete with the state jobs for good employees. But you're not going to be able to compete because you don't have a growing economy. You don't have a thriving economy. You have a service economy that relies upon state spending. That's what it relies upon. So you're going to have to compete with people that can go get a job at the state, a better paying job at the state with benefits and everything, right? You're going to have to compete with that. So from the private industry, from the private perspective, you're like, doggone, it is awful hard to find good employees. Because every time I hire one, they leave and they get a little bit of experience and then they go work for the state. And those state jobs pay a whole lot better and they got benefits, and I can't afford to give benefits to my employees, right? So you're being outcompeted by government that's growing, and it's got a free source of revenue. It just grows every year. Pay raises for everyone this year. We got $200 million more permanent fund earnings. We're going to give raises. The private sector is not going to get a raise. You just eliminated the dividend. There's no raise. There's no connection to the private employer. So in a real sense, if you're going to set up a government that's got all of the preferential treatment, it makes it more difficult for the private industry to exist. And never forget that one of your political parties in this nation, in this state, the Democrat Party, has already asked the previous administration, the Biden administration, to help get rid of the oil and gas industry in Alaska. So what are the odds that we stick with Republican pro-development presidents and administrations in Congress and in the executive branch at the federal level? What are the odds that we stick with that, with pro-Alaska, over the next 10 years? Is there greater than 50% chance that that's going to happen? I mean, look at it from an investment perspective. I think there's at least 50-50 chance that you're not going to have people that are pro-Alaska development in charge in Washington, D.C. And then what? I mean, we're only a couple elections away at that point from taxing industry out of Alaska, because it's going to kill us. Climate change is going to kill us, and we need to stop this oil development. You think I'm making it up? I think I've got it right here. This is it. Let me scroll to the top. Alaska Dems resolution 2022. This is their party resolution. This is the party that some Republicans enabled in our current legislature. Be it resolved, the Biden administration must end the era of fossil fuel production and use all the tools at its disposal to avert further climate devastation in Alaska. Declare a climate emergency and secure resources to build out clean, renewable, and distributed renewable energy. Encourage the oil and gas industry in Alaska to re-engineer itself and invest in renewable energy. Phase out fossil fuel production leases and permits on public lands and waters. Get rid of oil and gas development in Alaska. That's what the Alaska Democrat Party adopted as a resolution. The following resolution was proposed by the Climate Caucus and adopted by unanimous consent at the Alaska Democrat Party State Convention, May 7th, 2022. Those people haven't gone away. Again, when did a limited government fiscal conservative become no tax? We became small tax. We became the government should only do what we're willing to pay for. So don't grow government and ask me to pay for things that I don't want government to do. But we have never been, don't care what the size of government is as long as you don't tax me. We've never been that. That's the state of Alaska. The state of Alaska is going to be an anomaly in the union. We literally have a situation where if we do not implement some connection to our private economy, some sort of broad-based, low tax, our government is going to continue to grow without taxes. Our permanent fund is going to enable a socialist government, a growing government. And we will have avoided taxes for some period of time until those who are dependent on government or dependent on that state dollar decide that they want more, and they come to people who are not dependent on the state government and institute a tax. Fiscal conservatives, Republicans, limited government people, whatever label you want to put on yourself, we had better wake up. We had better wake up to the reality of what is happening in our state and have a different solution. Have a plan that communicates the importance of our private economy and the importance of not asking your government to do things you're not willing to pay for. Again, it will be no skin off the politician's back to say yes to that program that the voters are asking for, because the voters don't have to pay for it. Nobody has to pay for it. The permanent fund earnings is going to pay for it. What do you fear more? You fear taxes more than you fear large government? Like this overreach that we have in the federal government, man. We're only a few years away from having that type of attitude in our state government. All right, folks. Thanks for joining me tonight. We will we'll see you later. Appreciate your joining me tonight. Have a good night. See you tomorrow.